Market Domination. I'm Julie Hyman alongside Jared Blickery in for Josh Lipton today. We are live from our New York City headquarters, and we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed before the closing bell rings on Wall Street.
Yes, the headline number is solid, but what we're seeing is weakness in manufacturing, but also weakness in B2B businesses tied to white-collar jobs and professional business services and information. So this is not a one-note jobs market. There's some weakening trends tied to both consumers and producers that bears attention.
The Fed does face a tricky situation, though. I think there's a sense that if they leave rates at this level for too long, it could trigger a recession. So the Fed is trying to balance the risk. They want to start trimming rates, but there's a real question as to whether those rate cuts will start in time to make it a soft landing rather than something of a more serious downturn.
When we look at the depreciation expense coming through from all this CapEx build, we think we have it in the models, and as long as the top line growth is there, and they cut back on employees and other expenses, which we're seeing across the space, we think they can manage the extra depreciation that's coming through over the next few years.
We've got 1 hour to go until the market close. So let's start with the major averages here and see where we stand. We are seeing a rally across the board here today, although we still have divergence, as we've seen recently, between the Dow and the Nasdaq. So the Dow is higher, about a third of 1%, about 120 points or so, but the Nasdaq is up 1.7%. So big gap between those two averages, which shows the strength that we're seeing in technology today. And then there's the S&P 500, which is up about 1%, sort of in the middle here. What you have is economic data today going sort of against the grain of what we heard yesterday from ISM manufacturing. Today we had ISM services that came out ahead of estimates. At the same time, prices paid below estimate. So a better recipe for a stock rally today. And at the same time, we continue to have yields that are pushing lower to their lowest since around March now, 4.29% on the 10-year note. So if we look at what's going on sector-wise here today, you'll see that technology is indeed strong. The XLK up 2.1%. Industrials, communication services, and materials doing well. So cyclically led recovery or cyclically led rally today. And then you have the more defensive staples that are falling. As we talk about what's going on in tech today, got to talk about what's going on in the Nasdaq 100, where you see, I know we're not saying Magnificent Seven anymore, but the Magnificent Seven are rallying today. Let's just say that. Nvidia leading the way. We're going to dig into that a little bit later, but it's up 4.5% right now. But you see the other large cap tech stocks are also gaining ground, Jared.
Yeah, it looks like the Nasdaq 75 there, or the Mag 75.
Yeah.
I think investors will take that. So It's another day, it's another drumbeat of data. And according to ADP, private payroll growth, it slowed in May to a 4-month low, providing yet another sign of weakness in the labor market. Here to discuss what the latest readings mean for the broader market and your portfolio, we're joined by Glenn Smith, Chief Investment Officer at GDS Wealth Management. And thank you for joining us here today. What do you think about these economic reports we're getting? ADP a little bit out of consensus today. Everybody looking ahead to that big payrolls report on Friday.
I think the market's trying to digest all this information. The payroll numbers Friday, we think they're going to be in line with the last few months. Probably expecting about 200,000. 200,000 number, maybe 195,000. That, along with next Wednesday's CPI numbers, is going to give the Fed a couple things to digest in terms of what they're going to do with rate cuts going forward. I think the market is softening a bit as evidenced by the 10-year Treasury coming down. So I think there's going to be some opportunities here going forward in terms of volatility, and there's some signs of a little bit of a slowdown. That being said, unemployment numbers have been almost 27 months now, sub 4%, which is the longest streak we've had since the 1960s. So on a positive note, the economy, rear looking, has done well. Just forward looking, I think it could be a little bit of a different picture.
Yeah, and I'm curious, you guys have about $1 billion under management. What are you hearing from your clients about whether they feel like the economy is slowing or what their concerns are around the market?
Main concern we're hearing is regarding inflation. while it has come down from nearly 9%, trending to that 2% number the Fed wants, it's still higher than people would like. And the best opportunity to beat inflation when it comes to investing is going to be with equities. So most of our clients have, I would say, 60 to 90% of their portfolio in equities, knowing that it gives them the best opportunity to beat that inflation number. It's important on the fixed income side of the portfolio to remember if you believe that interest rates are going to come down some in the next year or two, you want to look at extending your duration on the bond part of the portfolio to give you a little opportunity for a little bit extra yield.
I'm wondering what you like in terms of sectors here. Tech is outperforming today, as it has the entire year, but we've seen other sectors rise and fall in various fits and starts. Financials have reared their head. We've also seen some of the cyclicals pick up. And just wondering where on the spectrum you fall when it comes to some of these large cap sectors.
Well, tech's done amazing. I think a lot of the easy money's been made at this point. The two sectors that we find most attractive are going to be financials and energy. Financials, we love JP Morgan, best of breed bank in our opinion. While it's had a rough couple years with investment banking, we think that's going to start turning around. In terms of if interest rates stay elevated, it has a bit of a hedge. Net interest margin should do amazing with JP Morgan. And if rates do come down, lending should pick up. And you can invest in the JP Morgan at 11 times earnings, which is very attractive when you compare it to a magnificent 7, if you will. In terms of energy, we love Halliburton. It also can be invested in at 11 times earning, one of the largest oil service providers on the globe. And it's doing very well financially, even though oil is only at about $70 a barrel, which is a sweet spot. And we think it's a bit of a hedge geopolitically. If things start to kick up in the Mideast again and oil goes up, Halliburton will do that much better at $80, $90 a barrel.
Hey, Glenn, I'm curious here about Halliburton in particular because the financials might look good, but the stock price doesn't really. We've seen it actually underperform the rest of energy. So I'm curious why you want to get levered to oil through a services provider like Halliburton versus a pure sort of E&P play.
We think the little bit of a dip it's had is actually an opportunity for our clients, not a catastrophe. If you're looking for a short-term play, it's anybody guesses. Long-term, we think it's still priced very attractively, and the recent dip could work in our favor. Dollar cost averaging at these levels with a stock like a Halliburton.
What's on your horizon? What are you looking forward to in terms of a potential catalyst, or what are you concerned about in terms of a potential headwind?
In terms of a headwind, it's going to be this inflation. It's going to be interesting as the Fed digests the numbers coming out. We no longer think there's going to be a rate cut in June or July. At this point, we're thinking there's going to be a rate cut in September. And what we're hoping for is just not to have sticky inflation or that the Fed cuts rates too soon. And we have a situation like the 1960s where Arthur Burns cut rates too soon and we had persistent inflation for many years to come. So our main concern right now is inflation and how do we fight that in our portfolios.
So I want to circle back on that front to the allocation to stocks, right? As you mentioned, 70 to 90%. That seems pretty high, Glenn. So that's interesting. Like over history of investing for clients, how often have you been at 70 to 90% in stocks?
It depends on every client's going to be a little bit different. Most of the clients that we work with, they're pulling out 3 to 4% of their portfolio. And when interest rates are at their place at where they are now, we're a little bit more heavy fixed income today than we've probably been in over the last 6-7 years, because you can get an attractive corporate yield or a treasury yield where you couldn't 2 years ago, say. So right now we're a little bit more on the fixed income heavy side than we have been in recent past. But we think over a 10-year period, to give you the best opportunity to beat inflation, it's going to be equities, where historically they've done 10% versus a fixed income where you're going to look at 4 to 5%.
Glenn, real quick, we got about half a minute. Anything we missed here today that you want to tell investors?
I would just say this is a great time to look at your portfolio, make sure you're diversified, a lot of allocations and kind of gotten out of whack with Magnificent Seven, everything going on. Make sure you're not over concentrated in any one sector or stock that might be a little bit speculative at this point.
Glenn, thanks a lot. Appreciate it.
Thank you.
We're just getting started here on market domination. Coming up, Hewlett-Packard Enterprise shares touch a record high in today's session after strong AI server sales fueled a revenue beat in the company's most recent quarter. Our executive editor, Brian Sozzi, spoke with HPE's CEO about the blockbuster results. That conversation is coming your way next on Market Domination.
One of the hottest stocks in the market today are shares of HPE after a much better than expected quarter and a pretty upbeat outlook amid all things AI. Let's get right to HPE CEO Antonio Neri. Antonio, always great to get some time with you. And boy, we were sitting here 3 months ago. This was a different story. We're talking about some delayed orders, maybe things slowing down a little bit, but I didn't get that vibe on this quarter. What in the world happened here?
Well, Brian, thanks for having me today. Actually, we have been a consistent story. I think the market is finally waking up to the idea that HPE has a big role to play in AI. And I'm very pleased on the fact that we continue to execute our strategy and delivering the results we did, like in Q2, where you see that we beat revenues and non-GAAP earnings per share on the back of the AI system revenue conversion, which more than doubled from Q1, now exceeding $900 million for the quarter. So HPE is uniquely positioned to capture the AI inflection point that we see continue to drive the momentum in hybrid cloud, and obviously the networking piece of this is super important as the market in that particular segment recovers. But today is an AI story, no question. And as we think about the market evolution, we continue to see very strong demand. We continue to see that demand accelerating. And what I'm really pleased about that demand is now that more than 15% of our cumulative orders now represent enterprise AI.
You've always been good in sharing how much in terms of dollar value in orders of AI-related products and services you have. What's the number now? Because you have been very consistent with us. Every quarter we talk to you, Antonio, that number has gone up pretty significantly.
Yeah, we execute Q2 with a cumulative AI order book of $4.6 billion. In that number, we converted more than $900 million in revenues. But what is important to realize is that that revenue had solid gross margins, operating margins. And that's because we have been very prudent in managing our cost structure, being super disciplined about the deals we pursue, where we see path to profitability, but most importantly, drive our portfolio of product and services without just focusing on the server itself. And then you can see in our disclosures, Brian, is that we start disclosing the services pull through, which is now getting bigger and bigger. Also because in many of these deals, we actually not only ship the server, but actually provide the full data center infrastructure, and actually we run those systems on behalf of customers.
Last time we talked, Antonio, you really were one of the first executives to bring up to me, at least in the tech space, companies having trouble implementing the AI stuff they are ordering because of energy. They couldn't get enough energy into their various systems. Where does that stand now?
We're still constrained, Brian. We're still constrained. And as I think about the future, right, we're going to be constrained. It's not just the space. Obviously, there is a lot of new build outs that we see in the market in the US, but also in other geographies. I think the sovereign clouds will have incremental demands on that data center capacity. And obviously, we need more clean energy, more sustainable energy as we go forward. And as you think about this silicon accelerated computing that's coming next, as you saw in the roadmaps announced by Nvidia, for example, they will require 100% direct liquid cooling. And that's a unique opportunity for HPE because HPE is one of the only companies that can actually do all type of cooling. Air cooled, which is the traditional way to do it today, but that's not going to be sufficient when you exceed the 1,000 watts per socket, and the next generation is going to be close to 1,700 watts. Then you have what I call the hybrid, which is most of the companies do today. There is a 70% liquid cool, but also using fans to cool the environment. And HP does both. But what HP is unique is the 100% direct liquid cooling. And we have done this for many customers. And in fact, three of the largest systems we have deployed for generative AI are today 100% direct liquid cooling. So it's a combination of space, cooling, and the technology used to cool down the systems with direct liquid cooling.
Yeah, it sounds like you got a lot of cool stuff working, Antonio. Why were the margins down in your various segments, and when did those start to improve?
Well, I think overall margins were down because of the mix of the business, right? So obviously, as we know, the networking market is going through a transition. And we have done a fantastic job over the last 2 years, adding $2 billion of revenue in our networking segment, which obviously comes with a different structural gross margin profile. And as the market is going through the what I call digestion of the inventories. By the way, we expect a modest sequential demand improvement in networking as we go forward here, which is a positive news. Obviously, that drives the entire company's margin. But if you look at our server segment, we grew revenues 18%, and we delivered 11% operating profit, which is in the ranges we guided the street between 11 and 13%. So it's very, very positive.
Since you work so closely with Nvidia, you know Jensen for a while, I imagine, how important is that company to the AI build out around the world? Because all we hear about in media land is maybe there's an AI bubble, they can't get enough chips out, we see AMD doing chips, but just from an Nvidia perspective, like how important are they?
I think they are changing the world with an amazing innovation, obviously, that the company and Jensen himself have been driving for more than 2 decades. You know, when you hear him talking about it, right, it has taken him personally two decades to get where we are today. I think we're all a little bit surprised about the advancement of generative AI from the algorithm perspective, but from the silicon perspective, I'm not surprised at all. And so I think, together with company like us, we'll change the world for better in my mind. And HB has unique value to bring to the table through our expertise of decades, deploying AI at scale, to our services organization, to the ability to build these systems, Brian. So HB today is one of the largest companies that has the water-cooled infrastructure to build the system. It's not just cooling the systems, but to build the systems, you need a lot of water capacity and power to build it. NHP has one of the largest footprint. So Jensen understands that, but ultimately it's how we engineer solutions in a way that is easy to deploy. And this is going to come down to the experience, not just the system performance and the sustainability of the systems and the return on invested capital, but it's going to be that experience. And enterprises need a simplified experience to deploy this amazing technology, which is going to change the world forever.
Pretty amazing time to be in tech. Well, good session for shares of HPE after a better than expected quarter and a relatively upbeat outlook. Antonio Neri, we'll talk to you soon.
Thank you, Brian.
And sticking in the AI space, the top trending ticker on Yahoo Finance right now is Nvidia. Stock hitting a new all-time high intraday, and the company hitting a $3 trillion market cap. And yeah, you can see it on your screen there. And we've been monitoring Nvidia's progress from 1 to 2 to 3 trillion, and yeah, it keeps going up. I guess that's the trend that we take note of here.
I guess that is the trend. I mean, let's just pause for a moment. Yeah. What a remarkable, I know that we talk about NVIDIA every day. Josh Lipton frequently jokes that we're contractually obligated to mention it at least once a show, and we mention it a lot more than once a show. But, it is remarkable the journey that this company has been on in the past few years with its triple-digit revenue growth, now getting to that $3 trillion market cap. By the way, its market cap is now larger than that of Apple's. And so, it is just remarkable because of this demand for these AI server chips. And the fact that investors are still piling in here ahead of this, that they see the stock split also as a catalyst is quite interesting. The stock's about to split. Which is sort of neither here nor there in some ways, but it's seen as something that maybe could drive some more demand. Yeah,
what impresses me here, and by the way, I was just watching Apple and Nvidia here trade places. That was what I was trying to point out. If you're lucky, you might catch it happen here. But my point is, Nvidia's multiple has stayed relatively the same, and that just means that they're actually meeting the hype, that expectations of investors are being met and consistently exceeded. So. And
speaking of consistently exceeded, on Monday we got a fresh new street high price target for Nvidia of $1,500 a share. That came to us from Bank of America. So there is still this optimism that it's going to keep going. Soon to be 150, exactly, because of the stock. But just a quick thing to mention here is that because of the NVIDIA ecosystem, it's not exactly a rising tide lifting all boats today, but it's lifting some other boats, because we also got a report that Taiwan Semiconductor, a company that it partly owns called Vanguard International Semiconductor, that they're going to begin construction of a facility in Singapore to sort of diversify the manufacturing holdings. That's going to be in cooperation with NXP Semiconductor. Taiwan Semi's up today. NXP is up today. Of course, there's the NVIDIA Taiwan Semiconductor connection here. ASML is going to provide some of its advanced chip making
That's
equipment.
Another story.
So, again, it's this whole ecosystem, and all of them are higher today.
Yeah, it's a confluence of a lot of government money meeting actual demand, and just the whole thing just kind of feeds on itself in it's called a virtuous cycle.
It does. And then on the flip side, from all of that going on, you see a company like Snowflake, which is under pressure today.
Software.
That's a top trending ticker. There was an upbeat response initially to its user conference this week. The company CEO saying he is looking for deals in AI to stay competitive with peers. Now, at the same time today, there was a deal done by one of its biggest competitors, Databricks, which is buying a company called Tabular. But some of the analysts in following this conference did express a little bit of skepticism here. One analyst at Evercore said the company is still in show me mode, as analysts like to say.
Yeah, they also continue. So this is also Evercore, which rates the stock outperform, price target 225. They also said the pace of innovation and urgency to ship AI products has accelerated, but it is in the early days of the AI front. And let's go to the Wi-Fi Interactive. I just want to show what has happened over the last month in software. You're seeing a lot of red. So that's just kind of the picture I wanted to show. Now look at semiconductors. sectors, and I'll give an equal weighted view. That's just the polar opposite there. So vast difference between software and chips now.
Yeah, speaking of swapping places, right? Like
Good
we've
segue.
seen, well, that's what we've seen with semis and software as well.
Yes.
Let's talk about another group that is under pressure today in a very different industry. Companies in the pharmaceutical sector, specifically focused on psychedelics, are under pressure. That's after a key vote from the Food and Drug Administration. Anjali Kamlani is here with the details. Anj, both of you and I are fascinated by this story. There was an exploration, and so is Jared. There was an exploration of MDMA to treat post-traumatic stress disorder. So there was some question about whether the FDA panel was going to recommend that to approve it, and they did not.
Right, and that's just the panel. We have to remember that the FDA still has until August 11th to take action on this. So what happened was one company, Lykos, got their chance in front of this panel to explain and describe this clinical trial. Now, the problem that the panel had is that what was effectively unblinding. So we know that the gold standard for clinical trials is to make sure there's a placebo group and a group that receives the treatment. Now, in taking MDMA, also known as ecstasy or Molly, you can't
know that you're not on it.
You're right. You can't know that you're not on it. And so that's sort of where the conversation took place, and that's where it went. There's also questions about whether or not you can prevent it from being abused, which has also come up, it's important to point out, in conversations about marijuana and those medical marijuana cases, trials. And that has been a point of contention as well there. Important to remember, FDA has not approved any medical marijuana for use. They've just used stuff that's related to other parts of the cannabis plant. And that's why it hasn't come up as strongly in conversation as we saw with this. Now, there are other companies out there, MindMed being one of them that analysts are focused on, that has a better mid-stage clinical trial coming up that could surpass what Lykos had. So there is still a little bit of hope, essentially, but right now what you're seeing is just pressure on the industry, pressure on the sector in particular, to really think about how they can actually bring this to market and really prove the medical use case.
And it seems like when we're trying to draw parallels to the cannabis movement and how it became legalized, it was illegal for decades, and then suddenly there's a groundswell movement, it gets approved by the states. This is different. It looks like quite different.
This is different.
There's no talk of recreational legalization at all.
In fact, because there is also talk about how there will be access to it. It already is access to it, has been for decades, off market in the illegally, and so that could continue and then push the illegal use of it further as a result. So there's been a lot of focus on some of the same sort of topics, but different angle, because it's a different drug altogether with different sort of impacts to the person's body. So that's sort of where the conversation goes.
Interesting.
All right, thank you, Anj.
Of course.
And moving on, we are watching shares of Riot Platforms. Shares are down about 2%, well, off the lows of the session. The move coming after short seller Kerrisdale Capital is out with a call to, guess what, short the stock. And also while being long Bitcoin, so a Paris trade. Joining us now is Kerrisdale Capital founder and CIO Sam Andrangi. And thank you for joining us here today. Just tell us, what's your thesis here, your investment thesis, long Riot, and then maybe pairing that with a Bitcoin position as well. Or excuse me, short Riot, and then the long Bitcoin.
Yeah, I mean, I think our investment thesis is that this sector is just not going to be around in 5 years. Bitcoin mining is one of the stupidest business models we've come across in our time short selling over the past 15 years of running Kerrisdale. Basically, barriers to entry are zero. Companies from all over the world can buy these ASICs from China, take them next to a waterfall in South America and get much cheaper access to electricity and be a lower cost producer. And basically, if you look at the economics behind all the Bitcoin miners in the United States, they don't make money. They just issue shares to pay themselves, a healthy stock comp and buy more ASICs and, never really generate a return. And the whole thing is sort of a scam. And we sort of published on Riot today, plan to publish on more. As this whole sector ultimately goes to zero.
Sam, I have many questions. First of all, if it's just a commodity and there's nothing differentiating, what makes that a scam? I mean, something could be a bad business model without being a scam. That has some connotations here, that there is something illicit or illegal going on.
Horrible business model. Sure, it's a horrible business model. It's not necessarily technically, a complete fraudulent, illicit actions. But, this is just as bad of a business model as you can get. And what you see with terrible business models, think back to cannabis companies in 2017, 2018. When you're the CEO of such a terrible business, there's a lot of shady things that you do. And essentially, you're just sort of enrich yourself at the expense of shareholders. And that's what's happening here.
I want to read a statement that came to us via Riot, and this is, here we go. We disagree with the characterization of the Bitcoin mining industry and of Riot and the equally unsound conclusions reached in the Kerrisdale Capital report. We believe these areas will be demonstrated through the execution of our ambitious 2024 growth plans and resulting financial performance. What do we know about these growth plans? And then, I guess, how do you balance that against the incredible shares that have been minted, diluting the shareholders to pursue its growth?
Yeah, isn't that absurd? This company has diluted shareholders by 18% already year to date this year. I'm looking forward to that growth and dilution over the course of the year. Maybe they might be able to even get up to diluting shareholders by 50% just this year, maybe another 50% next year. Since 2020, the company has increased its share count by multiples. And this is just par for the course across the entire industry. When they talk about growth, they just mean spending more on CapEx and buying more computers. But you know what? So is everyone else in the US, and so is everyone across the world. And so what you sort of see is that the network hash rate just increases over time. Each month, each of these miners, including Riot, get less and less Bitcoins, even as they're plowing all of the cash that they're raising from shareholders back into buying more computers. It's just basically one big hamster wheel where they take money from investors, buy more computers, and then produce less Bitcoin per share each subsequent year.
Why, if the whole industry is so terrible, why single out Riot?
We got to start with somewhere. And so we started with Riot. And the other thing that we haven't talked about here is Bitcoin mining is horrible for the environment. China has kicked Bitcoin miners out of their country because it's such an absurd concept. You burn all of this fossil fuel to fuel speculation around an imaginary asset. This doesn't belong within U.S. borders. The whole industry should just get kicked out and be banished to other countries that want to deal with it.
Well, it's bad for the environment. We all share an environment, so if it's bad for the environment here, it's bad for the environment anywhere. Before we go, though, I do want to ask you about another short call that you had on MicroStrategy. This similarly, you were short MicroStrategy, long Bitcoin. You made that call, I believe, on March 28th. Since then, kind of flattish for both, right? So how long do you think it's going to take for that to play out? And, if you're talking about that sort of the stuff that it's necessary to fuel Bitcoin mining is such a dirty business, why long Bitcoin at all?
Well, I think as a trade, we want to be hedged, so we're short the miners. We think they're going to zero. Who knows what's going to happen to Bitcoin? Your guess is as good as mine. In the case of MicroStrategy, I think if it owns $14 billion of Bitcoin, the company should be valued at $14 billion by the market. What you see is a premium that makes no sense. Situations where they own $15 billion of Bitcoin, but the market's valuing them at $35 billion. A bank holding $100 is valued at $100. It shouldn't be valued at $500. So that's MicroStrategy. In the case of the Bitcoin miners, it's just a terrible business. And in both those cases, we own Bitcoin just because we think that those stocks are going to go down relative to Bitcoin. So that way we don't have a view on whether Bitcoin goes up 100% or goes down 50%. We're hedged.
Sam, thanks so much. Good to get your perspective on all of these different ideas. Appreciate it.
Absolutely. Thank you.
Up next, a trip down memory lane in our latest edition of Goodbye or Goodbye. We're checking in on a call from January to see if it's held up over the past 6 months. That's next on Market Domination. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're doing a price check on retail with the Goodbye or Goodbye scorecard. Back with us is Jay Woods, Freedom Capital Markets Chief Global Strategist. Now, Jay, earlier this year, back in January, you were here on the show and you liked Costco. And you said, say goodbye to Dollar Tree. So here's the trade since then. January 11th was where we were. Dollar Tree is down by 16%. Costco's up by 23%. So it turned out pretty well.
It did, and Dollar Tree's now down 20% after earnings today. So
Right.
unfortunately, the slide continues for Dollar Tree.
It does.
Yeah.
And so you are sticking with the same situation here. So let's run through it for people. And let's take Costco first as your goodbye, the stock that you liked and you still like. So let's get to the technicals first, because I know that is your bread and butter here.
It is. And when I came on last time, we wanted to look at it from a longer term perspective because something big was happening. It was trending up, as we see here, and then it kind of stalled in this area. When I came on last time in January, as a technician, the first thing we look at is price and something that changes. And we saw a major breakout on a weekly pattern. And to me, it's time to buy this stock. It's making a next leg higher. So the technical basis was there. Then you add in some of the fundamentals, and it was one of those stocks that was tough not to love. So that is why we looked at it on the 5-year. And now I think you may have a 1-year next.
We do.
Here you go. So now what we've seen.
This is the 50-day moving average, and this is the 200-day moving average.
Exactly. Now, the stock has continued to trend higher after breaking out. It consolidated a little bit around the 50-day moving average, and it took another leg higher. Now, the stock is up 25% year to date. It may not run like we've seen here, but when comparing the two stores, I think there's more juice to be squeezed in this trade. And over the long term, I think this is a better name to be in. It is slightly overbought in the RSI. We'll talk about that when we say things I don't like about the stock.
Gotcha.
But right now, it remains best in breed.
Okay, so let's get to some of your other points on the more fundamental side. You say the earnings here pretty consistent.
Extremely consistent. They've beaten 9 of the last 10 times. They've traded higher only 7 of the last 10.
Right.
The last 2 times they actually traded lower. You know why they traded lower? Because they didn't raise the prices on their membership. That was the complaint. They beat, their guidance was solid, but they didn't raise prices on their membership.
Well, is that going to continue to be a headwind? Because in this economic environment where people are feeling a little under pressure, are they going to be able to raise prices? And is that going to continue to be a little bit of a headwind for the stock?
Well, they had the opportunity and the story to do so, and they didn't. That's why their customer base is so loyal, and that's why the brand is iconic in its own sense. So that's what we keep seeing out of them. So when that's the negative story, I'm pretty positive on the stock.
You're not convinced. And then some of the other fundamentals you're looking at, you talked about the membership, that's part of it. And then just that sales is consistent and they have a strong worker base.
Strong sales, and the worker force, there was a survey, I don't know where the survey came from, but it's the happiest workforce out of big retail. And when you see an industry where people complain a lot and they look for better opportunities, the Costco worker is very happy to be there. And that, if you ever go in, it's such a great environment. And I think that just feeds to the Costco narrative. So it hits on technical fronts, fundamental fronts, and it's a stock that you just want to hold on to. Will it make that euphoric rise that we got to catch in January? Maybe not, but I think it's something that's going to continue to slowly rise over time.
A steady winner, perhaps. All right, let's get to what you mentioned, maybe potential downside here.
Yeah, well, last time I was here, I said, well, one of the headwinds, PE ratio is historically high. It was in the low 40s at the time. Now it's at 50. That is relatively high versus an average of the 30s. I'm not much of a PE guy, but it is getting a little frothy. And then when you look at technically the run on its relative strength index, it is overbought. Overbought does not mean it's going to turn, but it's going to struggle to go much higher from these levels. So I think the stock could stall, consolidate in this area, but it could probably be setting up for another leg higher in a few more months.
All right, and then on the flip side, you got Dollar Tree here, where it was underperformed. You say the price action's been negative, so let's get straight to your chart on this one. Here's a weekly performance as well.
Yeah, this is 5 years, and I like to look at it on 2 time frames. The longer term, what we said and we talked about it last time, it kept making a series of lower highs. Not the greatest line in the world, but what we're seeing is the stock very toppy and rolling over. What did it do? It just broke its 200 weekly moving average. It's not a line in the sand, but it's very negative. And then when you look at the fundamental stories behind it, they've had some struggles.
Yeah, but let's look at that. I know you wanted to look at the 1-year chart as well, so that's what we have here.
Yeah, and I love that we have gaps in the chart. Some people don't like the line charts with the gaps, but these
That's me, but that's all right.
I'm picking on you, I know. And then there's another gap, sadly, behind
the bear, appropriately enough.
Ironically enough. What we've seen here is the stock gap down and failed to fill that gap, and then what did it do? It rallied to the 50-day moving average, which is declining.
Went back down again,
went down, it went back to the 50 and down. This is what we call a nice downtrend. And then when you look at the story behind it, you can see why it's in that downtrend. They've got some work to do.
So let's get to that. Big retailers, including Dollar Tree, struggling here, lowering prices. I mentioned this sort of bigger environment.
Yeah, well, we saw Dollar General get hit last week. Five Below comes out after the bell today. You see how they're doing both in downtrends. And then their biggest competition, Walmart and Target, they're lowering prices now. That's even more competition for them because their margins are tight enough, being that it's a discount store.
Right.
So those big retailers lowering prices, it's going to make it even tougher for them going forward.
And then there's the albatross that we talked about before, Family Dollar. Now Dollar Tree says they're thinking about getting rid of Family Dollar after they fought so hard to buy that company.
Yes, $8 billion in 2015 is what they spent to buy Family Dollar, and they have over 8,000 stores of Family Dollar, 16,000 in the general family, so that's half of what's going on. They have not been doing well. Shrink has played a major factor. Shrink, for those that don't know at home, theft and damage in the stores. That has been an issue they've been addressing again and again and again. They are finally consolidating, and they said today they're exploring their options going forward, as you said. So that means they're exploring possibly a sale, a spin. I don't know if that would work, but right now they're trying to, curtail the damage that that brand has done to their overall brand of Dollar Tree.
All right. What could go right?
What could go right? Well, we could shrink the amount of stores we have at Family Dollar. We could consolidate there. That's good. Their numbers weren't too bad. So we're seeing progress made, but it's going to take some time. They're not just going to snap their fingers overnight. So improve those existing locations, and then they're not expanding. So, that wave of expansion, and we saw some of that, during COVID when, people, especially at the low-income retailers, were getting, an opportunity to go there and get a good deal. Right. It's just not there. So maybe rates coming in, that could help them, but they've got to kind of curtail what they're doing now. It looks like they're making progress in that, but price action, it's negative. Today wasn't that bad as far as earnings go, and we still sold off. Right. Watch near-term 112, longer-term 103 as support levels. If not, we could be in a double-digit number in the next 3 months, and that could be bad.
All right, so you're sticking with it. Buy Costco, avoid Dollar Tree. Do you have a position?
I don't. I wish I listened to myself, though. Costco was a good one. But no, I think there's more juice to be squeezed in these trades, and it's good to revisit them, especially after earnings and Dollar Tree.
I frequently wish I'd listened to myself. Jay Woods, thank you so much for being here. Good to see you. Yeah. Thank you so much for watching Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. We'll be right back with more market domination as we talk about fixed income in our investor playbook.
Treasury yields heading toward their fifth straight day of declines, which could be a signal of economic weakness. We're looking at how to navigate these moves with the Yahoo Finance Playbook. And joining us now is Michael Kushma, CIO of Broad Markets Fixed Income at Morgan Stanley, along with Chip Huey, Managing Director of Fixed Income at Truist. And let me just begin with the 10-year with you, Michael. We've seen these 5 days of declines here. We're approaching 4.25%, the lowest in about 2 months. What do you make of this decline?
Well, I think it's a reaction to the overreaction when yields rose quite dramatically in April and May on the back of some bad auctions. There was some inflation data in the first quarter that wasn't very good. Yields got up to about 470, and that was probably an overreaction to data which was technical. It wasn't that much of a deterioration in fundamental data. And since then, so not only did we have a cheap 10-year at that point, but the data in terms of inflation data and economic growth data have all been very positive for the reignition of this soft landing story that the Fed will cut rates, economy slows down, inflation slows down, but not too much on the growth side, and everything is good. So we're back to that Goldilocks world again.
Well, speaking of back to that, Chip, I want to bring you into this because what Michael alludes to is kind of like this whipsaw that we've been under. You know, there's going to be 6 cuts. There's going to be 3 cuts. There's going to be no cuts. Well, maybe there are going to be. I mean, like, it seems like we're kind of back to maybe a cut or 2 this year. I think you think that there's maybe a cut in September. Like, how do you even trade this when there has been so much volatility in those rate cut expectations?
Yeah, it's been very volatile, but I do think the Fed is going to want to see some more disinflationary evidence before it initiates that first rate cut. But the past couple of weeks of data suggest that those trends may be starting and maybe laying the foundation for the Fed to be able to go ahead and move. So we do think that the Fed will ultimately lower the Fed funds rate for the first time in September, leave that optionality open for a potential second cut in December, but allow the data to dictate that.
Michael, what's your opinion of the entire conversation surrounding the soft landing? And I'm asking it because this has happened maybe once, arguably in 1995, according to Fed lore. Economy was doing very well. But the reason I ask this is it looks like a soft landing until it isn't, until the data rapidly deteriorates and is very unpredictable. Where do you think the confidence comes with all these soft landing predictions?
I think it really comes to a repeat of the 94-95 scenario. I'm old enough that I was actually involved in markets in 94 and 95. I remember distinctly that period where the Fed raised rates very aggressively in 1994 from 3 to 6% in 1 year, which was unheard of for at least a decade. And yet nothing much happened to the economy. And the reason being is the economy had fundamental strength and there weren't a lot of imbalances. So coming in this whole rate hiking cycle, there wasn't a lot of credit overhangs. The private sector was delevered. The government sector re-levered up. We know the government deficit and debt has gone up a lot, but the private sector has been really, really good shape. So the rate hikes haven't reached the levels that would cause distress amongst important components of the economy. And the lack of distress, which is similar to what happened in 94 and 95, allows the economy to continue doing just fine. However, the Fed did pivot in 95. They realized in the 95, 96, their rates were on the high side. So they cut rates about 100 basis points. I think that's what's the most likely scenario. I don't know if it'll be September, December, but over the next 12 months, we are likely to see 100 basis points of rate cuts just to get things more in line with what a stronger economy, but not accelerating economy would need.
So if we're going to get cuts, whenever we're going to get cuts, let's talk about then how you position yourself within fixed income. Chip, I'm going to take this one to you. You know, we talked to one portfolio manager earlier who said many of his clients are 70% to 90% in equities right now, sort of as an inflation hedge. I imagine that's not what you're telling folks at the moment, but talk to us about, first of all, sort of allocation-wise, how people should be thinking about fixed income in this environment.
One thing that we're really talking a lot about is reinvestment risk, because we have seen a tremendous amount of demand in the first couple of years of the yield curve, right? So as the Fed starts to talk about and then ultimately initiate those cuts whenever they may come, we do expect over the next year or two to see yields in that part of the curve start to come down. And that creates reinvestment risk that when those maturities then come due, we are then in a lower interest rate environment. So what we're seeing based on where we are in the Fed cycle now is an increased value in duration. Yields out a little bit longer are still very productive, and you can lock in those yields for a little bit longer period and provide some insulation from that volatility that comes along with the Fed ultimately starting its rate cut cycle.
And Chip, let me ask you about corporate credit right now. Spreads have been pretty tight with respect to sovereign bonds, not that much more than a government-issued bond, such as from the United States. What are the conditions under which you would expect to see that change? What is coming down the pike that might turn that table?
Yeah, we need, in our view, we would be patient around corporate credit right now because, as you said, spreads just remain very, very tight, historically tight. And we don't think that really aligns very well with very tight Fed policy and a little step down in growth that we're seeing from a really torrid pace back in 2023. So we would want to see those spreads just better reflect the economic realities that we currently face, and then we may see more value there. And we think that opportunity is coming. But for now, we would be patient until we see that adjustment to wider spreads, better compensation for that, and a more improved kind of risk-reward landscape in credit.
And Michael, we got 20 seconds. Can you give us your real quick strategy as well?
The strategy is simple, short-term versus long-term. From a long-term perspective, fixed income hasn't been this attractive for 20 plus years. You have to go back to the pre-global financial crisis, early 2000s, with yields at this level. So from a long-term perspective, this is probably as good as it gets. 10-year corporate bonds yielding 5.5%, high yield yielding around 8%. These are very attractive absolute yields if inflation stays in that 2 to 3% area. In the short term, however, the yield curve is inverted. You're not paid very much, or you're not paid at all to extend duration. And we think you can be patient to extend duration because we're not that worried about a recession. We don't think the Fed will aggressively cut interest rates. So the curve will stay inverted for a much longer period than people expect.
Right.
So stick to sort of the 2-year to 5-year part of the yield curve.
Michael, Chip, thank you so much. Really appreciate it.
Thanks.
We'll be right back with the closing bell. Don't go anywhere. There is the closing bell on Wall Street, and now it's market domination overtime. I'm here with Jared Blickery. We're going to get you up to speed on the action from today's session. Let's start with the major averages. And even there was some excitement today. The Dow, not so much there. We saw a gain of about 0.25% for the Dow, about 96 points. But the S&P 500 closing at a new record high. This is the 25th record close for the S&P 500 this year, up about 1.2% on the day. The Nasdaq gaining even more by 2%, and it too is closing at a record today. And it's been an interesting day today because, you know, yesterday we got that manufacturing data. That came in worse than estimated. You saw yields fall, but it did not give a big boost to stocks. Today, you got the services side. That beat estimates. Prices paid came in lower than estimates. Yields still fell, but today stocks went up.
Yes, and when you look at the sector action, it's all about the tech sector. You got XLK up 2.22% in the upper left, then XLC, that's communication services, up over 1%. Those were the only two outperformers. Utility, staple, and real estate rounding at the bottom. And I'm going to show a picture of the Nasdaq 100. Look at all that green there. I do want to just rattle off some of the all-time highs we got here. We got Walmart, Royal Caribbean, Costco. Most of these not in the Nasdaq, by the way. McKesson. We also have Regeneron, T-Mobile, and Nvidia. So we do, and Micron. So we do have some staples in there, and I'll just show a picture of Nvidia real quickly here, up another 5%, 1,224, getting to that new street high target we were just talking about,
and
wherever
getting,
that was.
Yeah, and getting to, we want to dig into Nvidia a little bit because the record run, as you were just talking about, is continuing. The chip giant topping $3 trillion in market cap, at a record high today. And here to discuss more is senior tech reporter Dan Howley. Dan, you and I recently had the chance to talk with Jensen Huang, the CEO and founder of NVIDIA. And what we were trying to sort of get at was like, is this going to keep going? Now, Jensen is a big idea guy, a visionary. And he didn't say it in so many words, but he kind of said, yeah, it's going to keep going, and it has.
Yeah, I mean, look, they just closed above $3 trillion for the first time, also closed above Apple. So now they are once again for the day, the second largest company by market cap, just behind Microsoft. And I think, one of the things that is potentially driving this is the announcement of the new chips coming in the years ahead. He laid out the roadmap for what NVIDIA has to offer at Computex, basically saying that there's going to be an ultra version of the Blackwell chip coming, as well as Rubin, the new platform that'll be there. They say they're on a one-year cadence, and then the year after that, 2027, there'll be an ultra version of the Rubin chip. They also have a new CPU coming. And so, obviously they continue to iterate on these, not only iterate, but then come out with entirely new platforms, as well as the different individual features of those platforms, not just the chips, but the interconnects that actually make these servers work. And so that, I think, is something that is helping to push this forward. Of course, it's not just the hardware, it's also the software. We talk about this a lot. CUDA helping to build that kind of moat around NVIDIA itself and kind of insulating it. But, it's not like the competition isn't there. AMD, they announced new chips as well as a roadmap. Intel announced pricing, trying to say that they're just more competitive as far as pricing goes than NVIDIA. But at the end of the day, are people going to pick an Intel Gaudi chip or are they going to pick an NVIDIA chip? They're going to pick an NVIDIA chip if they want to get the best out there. And so
but they are going to have to pay for it. They're going to have to pay up for it. That's the difference. I mean, it's so interesting to me, not just to look at the market caps versus each other, but I'm just glancing at Apple's revenue for 2023 of $383 billion. NVIDIA is growing enormously, but its revenue, at about $61 billion. So Apple still, in terms of its revenue, in terms of its earnings, still dwarfs NVIDIA, but it's the growth prospects, right, that people are betting on there. But it is always interesting, like when you used to see Amazon versus Walmart, and Walmart's sales were so much higher, but Amazon's market cap and stock performance was so much better.
And a PE of like 200.
Right.
Yeah,
exactly. Which is not the case with NVIDIA, however.
Much more stable.
I think it's interesting just because, you look at something like Apple, and their market is, as far as the products they have, they're in a mature market. They're trying to enter new spaces with AR, VR. We'll see what goes on there, but they're talking about generative AI, or potentially we'll talk about generative AI coming up. But yeah, NVIDIA, I mean, look, there's tons of companies out there that, not just the hyperscalers, but others that want and need these kinds of chips, if they can afford them, and they're all angling for them. So we'll just see how much further it can go, and maybe they'll play in a less expensive area at some point to try to get people who don't have the money to pony up for those.
Yeah, we shall see. Thanks a lot, Dan, for hopping on to talk to us about this milestone, another one for NVIDIA. Appreciate it. I want to bring in our next guest here today and actually get his comment on this. I'm throwing him a bit of a curveball. That's Joe Brusuelas, RSM Chief Economist, friend of the show. Great to see you here in studio, Joe. We are going to talk about jobs. We are going to talk about economic data. But when we see this phenomenon that has been not just NVIDIA, but the whole AI push here, how are you framing it as an economic driver? We talked to Darren Ashimoglu yesterday, and he said it's not going to contribute as much to economic growth as people think. How are you thinking about it?
Funny, I just spent a week at MIT. I got to talk to Darren and other people there. Look, I think that it's going to be part of the economic narrative. It's really about the shadow of the future. It's going to drive growth, perhaps not as much as the hype's out there, but there's a fundamental business case for AI. Second, it's going to be part of the productivity boom. Right. Now, we've got a productivity boom now that's not really even organized around AI. That's still a couple years away. So I'm incredibly optimistic around the entire ecosystem that has to do with AI and all of its components. Moreover, I think it's a general purpose technology, like steam or electricity, that's going to transform the economy slowly over time. Now, there's going to be a portion of the population, people who watch Yahoo Finance, who are going to utilize AI in a way that's separate and distinct from the rest of the country. We'll see it there first. Here in New York, all of our friends who work at the systemically important banks, they've got research labs. They've been using AI and machine learning to manage their portfolios for a couple of years. They're way out in front of what's going on. It's one of the reasons why we as economists, we've put non-financial corporate productivity, because if we use the productivity in some parts of the corporate sector of the banks, it really skew the numbers. So we know about this. We can feel it, see it. It's tangible. When I open my quarterly statements for our portfolio, I know they're using this. I can see it in returns.
You know where I see it?
Where do you see it?
When I get an email from my kids' middle school warning them, we have ways of knowing if you're using AI in your work. I don't know if they really do, but so it is spreading beyond already.
Right.
It's spreading beyond just the sort of corporate sector.
No, and we've all learned to incorporate it in my lives. I travel a lot on business. I got the privilege of speaking on the U.S. and global economy. And the airline that I choose to use, AI runs their app extensively. It managed my whole experience in a smooth way, to be honest with you, that humans didn't. It's really improved the overall experience for the business traveler, from my point of view, based on our air carrier of choice.
Interesting.
Let's bring it back to the economic data that we're looking at this week. ADP is a surprise as always this morning, but we're looking ahead to Friday. And I haven't seen an expectation for a negative print in forever, and that would be an extreme outlier. But the strength that we've had, I don't even know what we're averaging, but it's got to be 150,000, 200,000.
It's a little bit more than that, actually. Yeah, but
okay.
Yeah, we're gonna get another good status quo-like number. We think 200,000 on the top line, total increase in employment, 3.8% on unemployment. 0.3% month-over-month gain in average hourly earnings translates to 3.9. Look, this is just solid, but not spectacular. I'd like to see wage growth slow a bit, but we're really doing quite well.
So what's too good? What's too spectacular that the market says, oops?
300,000 or greater. That's where we're either we've got a problem in collection of the data, we're undersampling and overstating, or the economy's reaccelerated. Now, it doesn't look that way to me based off the other real-time data. Sure, the ISM services were good today. You know why that is? And everybody out there get used to this. The upper 20% of the population of households is responsible for 50% of spending. Every 3 months or so, they're going to hit the accelerator. You're going to get a good number in retail sales, personal spending, or the ISM services, right? That's why the economy is just going to continue to chug along, I think, at that 2% rate over time. Now, that doesn't mean there aren't issues out there. We've clearly seen
more reports
deceleration in spending on durables. Why? Because of elevated finance costs. Look, we're at that point now where we're getting a little bit further away from the trough in the pandemic, where everybody who could took advantage of those zero rates and replaced worn out stock. By that I mean durables meant to last more than a couple of years. Washing machines, dryers, boring things like dishwashers, right? You move away from that, well, things wore out. You have to go and replace it, but it's not at 0%. Now it's going to be at 3, 5, 7, or higher, depending on your credit scores, right? People are rightly upset, and we understand some households are really having a hard time dealing with that price shock. Good talking points. We should always acknowledge the risks around the outlook, but does it mean the economy's slowing into a risky category? It does not.
So does that still mean, it feels like the soft landing narrative has been less assured as of late, but it sounds like you still think we're there.
Soft landing's in the rearview mirror. We're in a extended business expansion. We're just slowing back to trend, which is a good thing. It's what you want. So we can begin to talk about the Fed bringing down rates.
So
the ECB tomorrow too.
Yeah.
Okay. So tomorrow we're going to get the other big gorilla in the room. The ECB is going to cut rates by 25 basis points. Look, we think that's the first of 4 this year. We get one in September, October, then December.
From the ECB.
From the ECB, because they've slowed. We had the BOC today, right? Mm-hmm. They cut rates like 2022. They led the pack. Now in Canada, they've had zero growth for 9 months. The unemployment rate's been going up. It would have been a policy year not to cut rates there. They've got a sufficient disinflation in train to get them back to the 2% target. And the ECB, they're going to overshoot to the underside on 2%, right? But the US is going to be a little bit longer. We're not going to cut, I think, until September. The risk is the economy continues to outperform a bit, and it doesn't happen until December. What does that mean? Divergence between the central banks. The dollar's going to get stronger. And it's appropriate that it should, because we are outperforming our G7 peers.
What happens historically when the central banks around the world get a little bit out of step? Somebody's got to lead, and there's always going to be an outlier.
So central bank divergence results in financial market volatility, specifically in foreign currencies. Typically, it's emerging markets that pay the price. You saw what happened in the loonie today. You'll see a similar reaction function in the euro going forward. Now, my sense is we'll always overreact in the near term. But as we continue to see the economy cool, my theme is it's going to be a cool summer.
I can't wait. I'm in a turtleneck here.
As the economy cools and hiring cools. But we're just normalizing. That's really, I think, the important message here. Too many times we get lost swinging between 0 and 1, red light, green light. I don't think that's appropriate for the context in which we're moving.
So not a cruel summer.
A cool
summer.
I'm
cool
glad
summer's the song.
That's right. I'm glad you remember that one.
It took me a minute. I'm like, wait, is the song cool?
The Bananarama, the UK band from when we were all children.
Karate Kid soundtrack from back in the day.
We will spare people our pipes, but thanks so much, Joe. I appreciate it. Great to see you always. Well, we want to get you some earnings numbers. Lululemon just out with its numbers here. The shares are up by about 10.5%. So let's break it down for you here. The company's first quarter earnings beating estimates. Revenue coming in at $2.21 billion. That's about in line with estimates as well. And total comparable sales, excluding the effects of currency, up 7%. That is short of estimates. But there are some things that are mitigating what may be meh results otherwise here. The company is maintaining its second quarter and its full year sales forecast, which seems to be reassuring the market to some extent. And it is also expanding its stock buyback program by $1 billion. So it's stock buyback authorization here. I'm looking at some of the comparable sales details here. Comps were flat compared to the first quarter of 2023 in the Americas, but internationally comp sales were up 25%, that's 29% on a constant currency basis. I think that's really important here because the company's sales have been stagnating here in the United States, but they have been looking overseas for growth, and it looks like that engine is continuing here.
And just looking at the share price on the Wi-Fi Interactive, I have a year-to-date chart, and you can see down 40% for the year. So overall market's up 10, 11%. Lulu's down 39%, and then you tack on another 10%. Assume that comes tomorrow morning. You're still somewhere down here. So you still got a ways to go to climb that back. And you take a look at the entire pandemic picture. I remember the old arguments for long Lulu in 2020, and those persisted into 2021. Then we had that steep sell-off, and a lot of pandemic stocks did not come back. Lulu impressively made record highs once again here, but they've just had a difficult time executing this year. So maybe the execution problems in the rearview mirror. We'll see.
Yes, we will see, although there's a lot of competition out there, but we're going to talk about more of this next.
Next, an analyst joins us to dive into Lululemon's most recent quarter. Stick around, more market domination overtime on the other side. Lululemon shares jumping in after hours, earnings beating estimates, while revenue coming in just above expectations. Company also announcing it's raising its share buyback program to $1 billion. Joining us now is Bernstein senior analyst Anisha Sherman. And Anisha, thank you for joining us here today. What is your first impression of these Lulu earnings?
So on the top line, it's as expected. You know, the Americas comp, the U.S. comp is negative. The U.S. total sales is about flat. America's comp is about flat. That's kind of in line with expectations. I think they did better than expected on margins, which pushed up EBIT margin and pushed up some of the EPS numbers, both in the current quarter as well as in the guidance, which I think is what you're seeing in the stock reaction. But the big number that people were looking for was America's growth, and that's come in pretty much in line. So it's a bit of a relief rally that we're seeing in the market after market now.
Hey, Anisha, it's Julie here. Where did that gross margin beat come from, do you think?
It was a little bit of a gross margin beat, but it was actually more of an operating expense SG&A beat. I think they just did some better cost control and probably some better economics on their stores that probably drove some of that cost control. I think we'll hear more about it in the call that's coming up in 30 minutes. But that's really what drove the beat, because the revenue numbers were in line. We're actually slightly below guidance, but in line with expectations. But the margins outperformed.
I want to ask you about a report you recently issued, Are Niche Brands Killing Growth? And you had the opportunity to talk to a competing executive. Just what are your takeaways there? Is it a case that the competition is really eating away at Lulu, or is it just a macro thing that's going on?
I don't think it's macro. I think it's two things. One, it's the law of large numbers. This has been a really big and successful brand in the United States. This is the biggest market share holder in women's apparel in the US. And so, yes, it's macro, but it's macro in particular because this is the incumbent. And you can't keep outgrowing the sector when you're the incumbent. So it's that combined with the fact that there's now this long tail of new competitors that are going aggressively after Lulu. And so it's both those things together. And in past years, it's been a lot smaller and so able to continue to grow despite the macro not being super strong. Now it's big enough that when the macro slows down, its size makes it more exposed to that.
So, Anisha, I'm going to refer to another one of your notes, and the title of it, Overcorrection or Broken Growth Story. Now, I don't know that we learned anything remarkably new from today's numbers, but what would be your answer to that question?
I think in the Americas and in the U.S., we still don't know because the numbers aren't very strong. I mean, the implied comp in the U.S. is negative. The comp in the Americas total, including a strong result from Canada, is flat. So at best, they're about flat. They're probably trending negative in the U.S. They probably have a negative exit rate. And so it does suggest that in the U.S., this is a mature brand and it's not growing. In fact, it's shrinking. Now, the question is, can they offset that with international? And this quarter, they did. The international numbers have been really strong. But I guess as China macro continues to be a struggle as well, and Europe isn't particularly strong either, I think it raises a question of, does this algo work? If the United States isn't growing, can this company still grow? So I don't know if we've answered that question and driven confidence in that answer yet with this quarter. And I think we'll see what the tone says about where the exit rate is and where they expect the rest of the year to go.
If you had a question, if you could ask anything of the CEO or CFO, what would you seek? What would you ask about?
I think I would ask about the maturity in the United States. I would say, this business is not growing in the United States anymore. It's your biggest market. It has almost 500 stores, and it's not growing. So, kind of what do you make of that? Do you think it's maturity? Do you think it's just a cyclical trend? Do you think it's an avoidable error in your innovation and your product assortment? What's driving that? And then what do you make of it for future growth? And how does that impact your growth algo?
Well, hopefully you'll get that question on the call and we'll find out what the answer is, Anisha. Thanks so much. It's great to see you.
Thanks.
With 1 week to go until Tesla's shareholder meeting, billionaire investor Ron Barron is throwing his support behind CEO Elon Musk's controversial pay package. Our Pras Subramanian joins us now with more. So here, out of nowhere, well, not out of nowhere. I mean, we know who Ron Barron is, but, a little bit of a surprise entrant into this whole debate.
Yeah, I think he felt he needed to kind of weigh in on here, so he's all in on Elon here. I mean, look, he's made a lot of money with his Tesla investment, and he claims that Elon is the reason why, saying that, quote, in his letter, in an open letter, he says, quote, Elon is the ultimate key man of key man risk. Without his relentless drive and uncompromising standards, there would be no Tesla. So not surprising that he is weighing in on here. I mean, look, he said in a note in March on an investment sort of thesis kind of backing up the Tesla investment, saying that they made, $5.5 billion on a original $400 million investment back in 2014, 2016. So clearly he's enjoying his gains here. Now things have kind of come off a little bit recently for Tesla, but I think Barron's still on the camp and he's still all in on Elon.
Real quick, do people think that this is going to be some cataclysmic event if the shareholder vote goes the wrong way, in quotes, whatever side you're on? Could this end up being something that causes a lot of turmoil?
Yeah, I think there's concern that this vote result's going to have some volatility around the stock. Morgan Stanley did a kind of informal poll of their institutional clients, and Adam Jonas wrote about how many believe that if the pay package is approved, it'll be a positive for the stock. But if it's actually rejected, it could be a huge negative for the stock in the near term. So I think there's some concern next week ahead of this shareholder vote.
All right, thank you for that update, Pras. And time now for What to Watch Thursday, June 6th. We're going to start off with the earnings front. We're going to get reporting from Autodesk, JM Smucker, and DocuSign, among others. Smucker's announcing fourth quarter results ahead of the open tomorrow. Analysts expecting the food and beverage manufacturer to post flat sales due to its legacy business. The company also expected to face continuing pressure as consumers trading down to cut costs remains a headwind.
Shifting to the economy, new weekly jobless claims data coming out in the morning. Economists forecasting that number to tick up slightly to 220,000. This, of course, coming after today's weaker than expected ADP employment numbers and giving us more insight into the labor force ahead of Friday's monthly jobs report.
And moving over to housing, new mortgage data coming out in the afternoon. Rates went over 7% again last week and have been over 7% 6 of the last 7 weeks. This coming after this morning's mortgage application data. The number for last week fell again by 5.2% compared with the week prior.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton. And for the next half hour, we'll be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're watching. Another day, another data dump. ADP payroll growth slows to a 4-month low in May, but we're not done yet. Jobless claims tomorrow, and the Friday jobs report will round out a reading of the labor market ahead of the Fed's June meeting. Plus, what's the deal with deal making? A new study from EY signaling the M&A market could be in for a rebound in the second half of 2024. Already this week, we've seen a slew of announcements. We'll take a closer look at what is fueling activity. And big business in Texas. The Lone Star State has become a hotbed for corporate relocations across tech, energy, and construction. There's even a Texas stock exchange on the docket. We'll discuss what's driving the migration later on this hour. A recent survey from EY reporting that U.S. corporate M&A deal volume will increase by 20% from this year to next. And the outlook is it's only going up from there. We have the author of that survey joining us now, Mitch Berlin, strategy and transactions leader at EY. Mitch, it's good to see you. Thanks for being here.
Hi, Julie. Thanks for having me.
So I feel like the conventional wisdom for a while was the rates would really have to start to move down more meaningfully before we saw an uptick, well, in a lot of stuff, right? In housing activity, but certainly M&A was on that list. So is that what we need to unlock things, or are people sort of chomping at the bit to get deals done anyway here?
Well, it's a little bit of both, Julie. We do need the rates to come down a bit. You know, when we started the year, we thought that we'd have about 6 different decreases in the Fed borrowing rate. Now we're expecting about 2, but that's offset by the overall confidence in the market. Corporate profits are high. We have CEO confidence at an all-time high. 99% of the CEOs we surveyed in a recent survey said that they plan on doing a deal at some point in fiscal 24. And we're looking at GDP growth about 2.5%, which is a little higher than initially predicted. So we are expecting the market to come back despite the fact that we know we won't get 6 cuts in interest rate, maybe more about 2.
Mitch, what are some of the motivations that you're hearing from in terms of why companies are going after deals?
Well, part of it is that, you know, a lot of these corporations have been saying, let's talk about corporate, then we'll talk about PE. Corporate has been sitting on the sidelines for about the last year and a half, but they need to transact to transform. To try to transform through organic means just takes too long. The pace of transformation is too fast. So they really do need to do some sort of M&A to be able to continue to stay pace or stay ahead of their overall competition. They're looking to gain market share. So you see a lot of deals where they're acquiring competitors to gain market share. They're looking for product expansion. So particularly if you look at life sciences, they have M&A patents that are coming to expiration. They need to increase they have patents that are expiring. So they actually need to build their R&D pipeline. And so they're looking to increase that through M&A. You have capacity expansion. If you look at the oil and gas industry and the consolidation around the Permian Basin, and then tech is the largest sector that's doing transactions year over year, and this year is no exception. And that has a lot to do with all the emerging AI technology that companies are trying to acquire, as well as cyber technology to protect the data that they need to actually drive the AI that they're acquiring.
Mitch, I want to dig more into some of the sectors in a minute, but first, I also want to dig into the timing. You know, we talked about when rates might be coming down and what effect that could have, but the election also, I imagine, is something of a factor. Are we seeing sort of a rush of desire to get deals done, at least announced, if not closed, before the presidential election?
Well, if you look at history, in the last 2 elections, M&A started high in the first quarter of the election, and then it sort of tapers off towards the end of the year. It's hard to determine whether that has to do with the election or just the normal M&A cycles, where it's a little bit slower in the fourth quarter of the year. This year may be different because there are clearly different attitudes in M&A between the different parties. And so you have a party right now with the DOJ and FTC that's putting a lot of scrutiny on deals. If that party is out of office and the Republican Party comes in, there is potential for less scrutiny from the DOJ and FTC. What people falsely think is that the interest rates will be impacted by the election, but the Fed is really independent of whatever governing party is in. So the Fed will not increase or reduce or hold rates flat, depending on the party. They're independent, but I do think there are some emotional reactions around that are actually.
Imagine that, Mitch. But at the same time, as you referred to, right, this DOJ has been pretty active. Is that something that clients, that folks you're talking to are taking into account, whether they even decide whether they pursue a deal in the first place? In other words, has that put a damper on things over the past couple of years?
Well, we certainly talk about it with our clients, Julie, but what they're doing, it's not scaring them away from doing deals, but I think they're more cautious in how they're doing deals. And so what we're working with them on is, look, if the current structure of this deal doesn't work because it's going to be perceived as you dominating a certain product category or a certain geography, how can we restructure that deal so you still get that return on investment, but maybe it's a little bit of a different structure that will satisfy the DOJ and FTC guidelines. So it's not discouraging them. It's just we're working with our clients to create more scenarios than we have in the past.
And last, I do want to dig more into energy in particular, because there the deal activity has just been a lot, right? Because it's not just the number of deals, it's the size of the deals that we have seen. Of the ones that have been announced, I believe only one of the large ones has closed in the form of Exxon and Pioneer. There's still a lot that are pending. Do you think that we've kind of come to the end of that flurry of activity in that industry?
We have not come to the end. I think there's still a lot of big deals in the pipeline. I think we're going to continue to see more. These, particularly in oil and gas. Oil and gas balance sheets are flush with cash. So it's a lot easier for them to do deals because they don't have to go to the syndicated market to actually finance these deals through debt. As a matter of fact, if you look at the largest 20 deals in 2024, only 3 of them, this is across all industries, many of those deals were oil and gas, only 3 of those deals actually went to the debt markets to fund those deals. The rest were funded through cash or stock.
Mitch, thanks so much for your perspective. Really interesting stuff, and obviously we'll keep in touch as the year goes on.
Thanks, Julie.
Well, you've heard of the NYSE and the Nasdaq. How about the Texas Stock Exchange? Wall Street heavyweights are backing a plan to launch a new exchange in the Lone Star State. We'll have more coming up on Texas migration on Asking for a Trend.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
One state has been catching the eye of several corporations. Texas, becoming a hotspot for businesses to relocate to. It really has in the past few years here. And so if you look at this from 2018 to 2023, according to CBRE, they look nationwide at the cities and the number of corporate headquarters that they were attracting. Austin was number one here. We know how popular that's gotten. It saw a huge boom in real estate that now is seeing a little bit of fallout. Dallas as well, and Houston. So the top three cities in Texas. Then you see Nashville and Denver. This doesn't necessarily mean that there has been a population that's followed these headquarters. In some cases, it's just sort of certain executives that are based there in Texas, and the rest of the workforce might remain elsewhere. But nonetheless, it definitely has been a trend here. The latest news is that there is a Texas stock exchange that's in the works that's getting some big backers from the likes of BlackRock and Citadel. So that's just sort of the latest headline grabber of what's happening in Texas. But we wanted to talk more broadly about this Texas migration trend. Let's get Yahoo Finance's senior columnist Rick Newman in on this. Rick, we thought of you because there is sort of a politics overlay to all of this as well. Texas doesn't have income tax, right? It has a certain political tilt in recent years, although they say Austin's a bit of an island in that regard. So it's been interesting to see this kind of corporate move.
Right. I'm not sure it's that surprising, though, Julie. Governor Greg Abbott in Texas, he's similar to Governor Ron DeSantis in Florida. They characterize their states as places where woke goes to die. Don't bring your woke policies down here. We're all about business. Let's keep things traditional. So, when we're talking about a new stock exchange, I'll quiz the audience here and ask people, how many stock exchanges do you think there are in the United States? People might say, well, I've heard of the New York Stock Exchange, the NYSE, I've heard of the Nasdaq, so 2. And in fact, there are 13 stock indexes in the United States. There's one in Boston, there's one in Chicago, there's others in different cities. And I think most of those kind of harken back to a time when those cities in those areas were more like industrial centers, which they're not so much anymore. So Texas obviously is a business haven. Obviously, the U.S. energy industry is basically lodged in Texas, in both where the energy comes from in the Permian Basin and all the energy companies headquartered in Houston, for example. So I guess this makes sense, but it doesn't mean that big companies are just going to automatically jump from the NYSE or from the Nasdaq over to some less woke exchange that's based in Texas. I mean, there has to be a really good reason. Financial reasons. I mean, companies have to protect their fiduciary responsibility to shareholders. There has to be a good financial reason to change exchanges. I looked this up today. This is not something I really knew about, but NASDAQ has actually managed to lure a few companies from the NYSE, and they do that by saying things like, your stock will have less volatility on our exchange. Technical matters involving the close of trading and the auctions at the beginning, at the end of the day. And when the companies think, well, we think, yeah, that'll be good for our shareholders, they might make the jump. It doesn't happen very often. Maybe a Texas exchange would be able to get some IPOs in the energy market in Texas or in other parts of the market down there. But this could be, this isn't a bad thing, and it could be beneficial down the road.
Well, and it's interesting, I thought it was a bit surprising to see the reports that BlackRock was one of the companies that was backing this, considering they've come under fire from certain pension funds, for example, in Texas, who see them as their ESG agenda of the past as being somewhat quote unquote woke, right? And yet here they are reportedly backing this exchange.
I would guess that that this idea that this is somehow about ESG and DEI and all these multi-letter abbreviations, that this is a bit of a red herring because I think if any company were to actually choose an exchange based on something like we just want to be with where the anti-woke people are, I think I would guess you're opening yourself up to shareholder lawsuits if there's any claim they could make that that it's financially disadvantageous to be on some upstart exchange. I mean, the NYSE and the Nasdaq would tell you, look, we have the deepest markets, we have the most institutional investors on our platforms. We are the place you want to be to serve your shareholders. And I just don't think a CEO can say, yeah, but we want the anti-woke exchange. Right. I can see that not being that popular. So. Right. If this does get off the ground, I think that they would have to make a case on financial grounds that this would be good for, maybe right. It'll be, the Nasdaq, for example, focuses on tech companies, right? Even though it's grown beyond tech companies. So maybe a Texas exchange could focus on energy companies. I mean, remember, like when Facebook went public, there was a huge battle over which exchange would get the IPO. So maybe we have some big energy IPOs in the future, and maybe one of them says, we'll give it a shot with the Texas exchange right. because we think they're in our neighborhood and they have what we need. So maybe that's where this is going.
Maybe so. We shall see, Rick. Thanks so much for covering it for us. Appreciate it. Well, believe it or not, as of today, we are exactly 5 months from a presidential election. It's coming on Tuesday, November 5th. Voters will be faced with a choice, giving President Joe Biden 4 more years to continue the country's transition to clean energy or to bring back Donald Trump's more pro-big oil policies. Joining us now with a look at the energy landscape is Ernie Miller, Verde Clean Fuels CEO. Thanks for being here, Ernie.
Thank you. Good to be here.
So you guys work on developing sort of alternatives to gasoline specifically and other types of fuels. And so I wanted to get your perspective. Maybe I'll ask you in a little bit if you would think about listing on a Texas stock exchange, because you guys are based in Texas, right? But we'll get to that later, because I am curious your perspective on leading up to this election, where kind of we are in this energy transition and how pivotal the election is going to be for that.
Julie, Verde Clean Fuels focuses on we make gasoline, and we make gasoline from natural gas that's either flared or otherwise disadvantaged, either physically or economically stranded. And so we're helping producers solve a problem with associated natural gas that allows them to produce their oil more efficiently. And the upcoming election is interesting as it comes, but I don't see that there's going to be a lot of change regulatory-wise that's going to affect our business. This is a long-term play. There are benefits with what we do for oil and gas producers beyond the energy transition, and so a change in administration is not really going to change this for us.
Do you guys get any kind of incentives as associated with our IRA or elsewise with what you do?
When we use natural gas as a feedstock, like we're doing in the Permian Basin with Diamondback Energy, we do not. So we compete heads up with traditional refining, and we provide producers like Diamondback an alternative pathway to monetize natural gas, which in the Permian Basin is often zero or even negative value.
How does it get started? It's a byproduct of them getting oil out of the ground.
That's right. It's associated natural gas. So in many basins throughout the world, oil production is accompanied by a certain amount of natural gas. And when the infrastructure is either not there to get that gas to market or is constrained so that not all of it can get to market, you're naturally constraining your oil production. And the oil is going to drive the economics on these developments. And so the inability to move natural gas becomes a real problem for oil producers.
Well, and it's also, to go back to energy transition, most of these companies are trying to not flare natural gas because right. It is not great for climate change, et cetera, and also they're incentivized to figure out something else to do with that. So how much are you guys producing through this method, and sort of, like, if I'm driving a car around the country, what's the likelihood that I'm using gasoline that's been produced in this method?
Well, the Permian Basin plant that we're doing with Diamondback is our first commercial facility. And so what we will do there is take approximately 34 million cubic feet of natural gas and produce, in round numbers, about 3,000 barrels of gasoline a day. And we see opportunities. We see multiple opportunities in the Permian Basin, but we see great opportunities for us in other producing basins here in the U.S. And then stranded or associated natural gas globally is a real problem that we can address.
Gotcha. And so, what's the sort of growth plan for you guys?
Well, like I say, we've got multiple opportunities in the Permian Basin, and then several opportunities across the U.S. To me, what we do in the Permian Basin on this first plant is it really can be looked at as a case study for what can be done globally. If you think about the African continent, for example, there are billions of cubic feet of gas that are flared every year in Africa, and usually in places that have no refining capacity. So they're flaring natural gas on the one hand, and they're importing refined products at huge premium on the other hand, when that natural gas could be a resource that could give them a fair bit of their refined product need.
All right, now I'm going to throw you the curveball that I alluded to, because we just heard Rick talking about this Texas Stock Exchange that is raising money.
Yep.
Would you guys, what would be I'm just trying to get some insight into why people would want to list on various exchanges. Would a local exchange hold some allure?
That's an interesting question. We're traded on Nasdaq, and very happily traded on Nasdaq, but a Texas exchange is an interesting thought. It's not a mystery to me why so many companies are relocating to Texas. Texas has a great business environment. You alluded to the income tax and is very, very pro-business and will help you grow. So Texas is more than welcoming to business, but the idea of a Texas exchange is interesting. I'm interested to learn more.
Well, we'll check back in with you once you do and once it gets up and running. Thanks, Ernie. Thanks for being here. Appreciate it.
Good to be here. Thank you.
Well, coming up, a look at some of the stocks moving after hours on Asking for a Trend. Let's take a look at what's trending after hours. Five Below shares sliding after that company reported first quarter results. The company missing estimates on the top and bottom line. Comparable sales unexpectedly declining, down 2.3% versus the expected rise of over 1%. CEO Joel Anderson noting the macro environment disproportionately affecting core lower income customers, resulting in overall comp sales declines. And Five Below also cut its full year guidance. And we've got Victoria's Secret topping earnings estimates for the first quarter, reporting earnings per share of 12 cents. The estimate was 10 cents, while revenue coming in line with expectations. Victoria's Secret noting a challenging retail environment in North America and a very competitive promotional environment, i.e. lots of sales. The company reaffirming its full year outlook, but forecasting second quarter net sales will decrease in the low single digit range compared to last year. The shares not much changed. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a good night.